Corporate finance practice problem using Excel. Acquisition and earnings per share. Get ready. It's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. We're going to populate that into the blue area on the right-hand side, looking at an acquisition type of situation, imagining B corporation, thinking of acquiring A corporation. Information for the two corporations that we have thus far. We've got the total earnings for A and B, the shares outstanding, the earnings per share, the price-earnings ratio, and the market price. The earnings per share calculated as the earnings divided by the number of shares outstanding, and the price-earnings ratio calculated as the market price over the earnings per share. The price will be a percent premium over the market value. So we're going to, in other words, consider what the market value is and think of the premium, which is going to be 53% over the market value of the company being acquired, that being B company here. So if B issues shares to finance the purchase, how many shares would need to be issued? So once we determine what the price will be, then we're thinking about how the cash will be generated or how the funding will be generated in order to facilitate the purchase. We're going to do that by the issuance of stock from B corporation to generate the resources in order to make the acquisition. So let's think about the price per share. So the price per share that we're thinking the buying would be, it's going to be this 50% over the cost of the stock. So we're going to say then the company B has a stock price. Let's say stock price for B, or for company A, we're going to be purchasing, B is purchasing A. That's going to be equal to the 36. And we said that there's going to be a 53% over and above that price. So that's going to be the premium. Let's call it the premium percent is going to be equal to the 53%. 53%. Let's go ahead and percentify that by going to the number group and percentify. We're going to underline it, font group, and underline. That'll give us the premium in terms of dollars. The premium will then be equal to the 36 times the 53%. Let's add some pennies to that, adding a couple pennies. And then we got the price per share. So the price per share then is going to be the original 36 price plus the premium that we're going to pay 53% over on a per share basis, adding a couple decimals there, number group, a couple decimals there. So we're at 55.08, per share over the market price. Obviously, remember that when we're thinking about the market price, the value of the corporation on a market basis, we would take the market price times the number of shares that are currently out there. That's what the market is basically determining the market price to be. We're going to be paying over the 53% over what the market price is, which we're determining now on a share by share basis, meaning that we would be purchasing for 55.08 per share. So if we purchase the whole thing, all the shares that were outstanding, the price per share then would be the 55.08, making that a percent number group. Adding decimals, and the shares outstanding, we're going to say are the 345 shares outstanding. So we're going to font group and underline, and that'll give us the value, and we'll call it the market value because that's what we're willing to pay for it. Although, again, if you were thinking about the market value just in terms of the stock price before this point, we would be taking basically the stock price times the number of shares outstanding, the 345. The fact that we're willing to pay on a free market basis 55.08 for the shares outstanding means that would basically be the market price, given that's a market transaction. That's going to be the 55.08 times the 345,000 shares. That's going to give us our 19,002,600. We have the price earnings ratio that we can calculate, which would be the price per share at the 55. The 55, adding a couple decimals, number group, couple decimals, and the earnings per share then at the 2.3. And we're going to go to the number group, add a couple decimals, and let's add one decimal because that's our custom here. Underline in that font group and underline. That's going to give us our price earnings ratio, which will be then we have the 55.08 per share divided by the earnings per share, the 2.3, and that would give us our 24. And let's add a couple decimals, number group, couple decimals to that. And let's add one more decimal here just to keep it all even. Okay, so then we have the new shares to issue. So that means that if we are going to be then B company, or imagine we're B company here, if we're the purchaser, then, and we need the $19,002,600 to purchase, then the value in order to purchase, if we were to finance that through the issuance of shares, how many new shares then would we need to be issuing in order to get that, to raise that? We'd say, all right, well, the market value that we need to pick up is going to be the 19,000,026, and the value of our shares as B company, market price per share is $40, we're saying. So if that remains constant, we'd go to the font group and underline. That would mean that we'd have new shares that we would use to finance this of the 19,260 divided by the 40. We'd have the 475,065 shares. So how many shares would we then have after this took place, after the merger or acquisition? We would then have the starting shares, which would be the 2,200,000, and then got these new shares that we're going to use to finance, which is going to be equal to the 475.65, underlining that by going to the font group and underline. That's going to give us our total shares, which would be equal to the trusty SUM sum of the 2,002,000 and the 475.65 to get to the 2,675.65. And then we can think about our earnings per share after the merger or acquisition, and we could pick up the earnings for A. Earnings for A was at the 800,000. We have the earnings for B, which are at the 4,200,000. So total earnings would then be this trusty SUM sum of the 4,200,000 and the 800,000. Underlining that by going to the font group and underline, that would give us then the total earnings, and then we have the shares now. Total shares at this point would be the 2,675.65, and then we've got the earnings per share after, and that's going to be equal to the 5 million divided by the 2,675.65, which would give us, going to the number group, adding a couple decimals, the 1.87. So the 1.87, which is close to basically the earnings per share before the process.